All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So we're going to be getting back to the Double Play theme in this video. Over the last few videos, I kind of strayed and covered some related topics that I got off of the Double Play. In this video, I want to get back to an application of the Double Play, which is using the Double Play to reduce high interest credit card debt. And this is valuable because when it comes to the Double Play, interest saved is every bit as valuable as interest earned. So if that sounds interesting to you, stick around after the intro and I'll break it all down for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and this is the Double Play channel. I created this channel because I know how hard it can be to try and find information on investing in real estate using life insurance online. You know, a lot of the vendors out there have pretty pictures on their websites and they tell you how you should invest like the Rockefellers. But if you want to know how that's actually done, you need to call in and talk to one of their sales agents before you get any information. I like to put my information out there for free because I'm pretty confident that you want to deal with somebody that you know knows what they're talking about. And with everything out there, you can make that determination for yourself. So the goal of this channel is to give you everything that you need to know without ever talking to a life insurance agent. I mean, honestly, the only time you should have to call me is when you're ready to see what the numbers look like for yourself. And to that extent, I've got a link down to set up an appointment with me on my calendar in the description down below. So today we're going to be talking about using cash value life insurance to pay off credit card debt, or essentially just eliminating high interest debt by leveraging a maximum overfunded life insurance policy. So the goal of this presentation is to show you how you can both save for retirement and eliminate high interest credit card debt at the same time. Before we get started, just my usual disclaimers. Everything that you see in this video is purely educational. There's no tax advice, no financial advice, no legal advice. And the primary purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, so the way we're going to cover this today is by talking a little bit first about the case fundamentals. You know, just a high level view of what's at stake here. And then I'm going to talk about some of the advantages of utilizing this approach. We're going to take a high level view and talk about why it works before we dive in and look at the numbers, which is the fourth bullet point, the analysis. We're going to compare two scenarios. As with everything in the Double Play, you know, it's important to compare, you know, what if I don't do this? What if I simply pay off the credit card debt with my own money and then begin saving for retirement after that? Versus putting my money into a maximum overfunded life insurance policy and then leveraging that cash value to pay down the debt and then paying off that debt from there. So that's what we're going to do in this presentation. So let's get started. So the first thing I want you to know is that this is just an application of the Double Play. You know, in the Double Play, we're leveraging the cash value of a maximum overfunded life insurance policy to invest in real estate or anything for that matter. But what I want you to understand is that interest saved is every bit as valuable as interest earned. And it's important to understand that when you're utilizing leverage like this to pay off the credit card, the money that you put into a life insurance policy is going right straight to the cash value. I mean, obviously you've got the fees of the policy, which we'll address, but all of that money goes towards the cash value. And then you're getting a loan from the insurance company secured by that cash value that you're using to finance or refinance the credit card debt. So you're just going to make your payments using a policy loan. But the most important thing to remember is that your money is working from day one. So once that debt is eliminated, All of your money has been working and compounding interest all that time. All right, so now let's take a look at some of the advantages of doing it this way. One is first and foremost, you have a life insurance death benefit. If you're struggling to pay credit card debt and barely making it, life insurance is probably not something that you would have gone out and bought anyway. Or maybe life insurance is just not something that you would have bought anyway. But when you're struggling to get out of credit card debt, extravagances like life insurance, or maybe you think of life insurance as a requirement. It should be. People may put off that decision. So the life insurance death benefit really doesn't factor into the financial payoff comparisons that we're making in this analysis, but there's certainly an intangible benefit from the life insurance death benefit. The second bullet point here is financial reserves. This is your emergency money. It's recommended that people have at least 6 months worth of money set aside to cover living expenses if something were to happen to them, like they lost their job or some kind of other catastrophe. And you want that money in an asset that's liquid. So you don't want it in a stock market because, as you've seen very recently, this is August of 2022 when this video is being recorded, the stock market is down substantially. So you don't want your financial reserves exposed to the market or any kind of high risk investment. And if you're interested, I've got a video linked below where I talk about why a maximum overfunded life insurance policy is the ideal vehicle for your emergency fund. The next point is retirement planning. The next advantage is the retirement planning. So the cash value of any life insurance policy can generate tax-free retirement income. But clearly a maximum overfunded policy, one where you're keeping the death benefit as low as possible in order to maximize the cash value, that type of policy is going to give you the most bang for your buck in terms of future retirement income. And because we're utilizing the policy to pay off the credit cards, our hypothetical client here is getting an early start on saving for retirement. And then the last advantage is the double play. So the double play is leveraging the cash value of a maximum overfunded life insurance policy to invest in real estate. Normally with retirement savings, if it's a 401k or an IRA, you can't touch that cash value until the time that you retire. But with life insurance cash value, you can just sit back knowing that your cash value is in that account and it's growing in a principal protected manner at a nice, safe, consistent rate of return. And at any time that you want, you can get a loan from the insurance company or from a third-party bank secured by that cash value that you can use to go out and perhaps buy a rental property, for example. So that's the double play, putting your money to work in two places at one time. So will it work? That's the question we need to answer here. And anytime I do these type of comparisons, I want to compare A versus B with equal inputs. Does it make sense for you to use your money, put it into a life insurance policy, leverage the resulting cash value to make payments on a credit card? So all you're doing is swapping high interest rate debt for low interest rate debt, and get that done before you can even begin paying down the debt. Is it better to do that than to simply take your money and use it to pay off the debt directly? Anytime I do these types of comparisons, I want to keep the inputs at apples to apples. Same amount of money, same insured, same expenses, everything. So let's take a look at what the expenses would be in each of these scenarios. So our sample client is a 35-year-old male. He's got $12,000 sitting on a credit card at 20% APR. He can afford to put $1,000 a month toward either the debt, life insurance, or savings, but he can't do two of those, right? We're going to assume that if he's investing the money or saving it, he can earn 8% annualized growth on it. We're just going to assume a flat 8%, no ups and downs, wild roller coaster rise of the stock market, no fees or sales commissions on anything that he's doing. And we're going to assume 5.25% on the life insurance cash value, of course, accounting for the fees and expenses of that. And we're going to assume that the policy loan interest rate is at 4%. All right, for this analysis, we're going to take a look at two scenarios, right? We're going to be taking a look at comparing, just simply taking your $1,000 a month and using it to pay off the credit cards. And then once that's gone, once the debt is gone, using that $1,000 a month to invest in the market at 8%. Versus, we're going to take a look at the other scenario, which is the complex route of using that $1,000 a month to fund a life insurance policy, maximum overfund the life insurance policy. We're going to leverage the cash value, take policy loans, and use those policy loans to make payments on the credit card. So we're simply swapping high interest rate debt for low interest rate debt. And then once we've got the debt swapped over to lower interest rate, we're going to cease making premium payments on the policy and use the $1,000 a month to reduce the debt on the policy loan, and compare this against the other scenario where we paid off the credit card directly. So let's take a look at what the numbers look like. Let's take a look at this first table. Here we're looking at the status quo. So this is utilizing your cash directly to that $1,000 a month to pay down the $12,000 credit card balance. We're going to use that $1,000 to make principal and interest payments. And you can see here that the debt is eliminated by the 14th month of the policy, or after the 14th month of the policy. So since we're dedicating $1,000 a month to this, we can't begin saving until the debt is completely eliminated. So in this next table, here you can see, here we're looking at beginning to save and make investments with the money. So you can see the first 14 months are pretty much empty, except for that last 14th month where there's a partial repayment of the loan and a partial investment. But otherwise, we're seeing $1,000 a month going into savings, earning 8%. So we see the net income of that and everything being reinvested. And what I really want you to take note of here is that by the 30th month, the savings is up to $16,126.82 down in the bottom right corner of that table. And we're going to compare that to this, which is the double play scenario. So this has two aspects of it to it. We've got to first swap all the debt off. So we're just simply going to fund a life insurance policy with $1,000 a month and then take as much of a policy loan as you can get away with. I'm assuming that you can get basically about 95% of the available cash value. The insurance companies usually require that you leave something back to cover the first year's interest, for example. So our $1,000 of premium turns into about $839 of cash value that can be leveraged for this particular client. And again, if you've ever heard me talk about in other videos, you have a properly designed policy when your cash value is approximately 85% of the premium. So if you're paying $1,000 a month, $850 would be 85%, but we're leaving a little bit behind, so $839 is what we're borrowing, and then we're paying incrementally the interest on that policy loan in addition to the interest on the credit cards, and the balance is going to the loan principal, the credit card loan principal. So here it's taking 17 months to completely swap out that debt versus the 14 months that it took to just simply pay it. So you're paying for longer. But it's important to understand that the debt here is at 4% as opposed to 20% for the credit card. One thing of note also is that for months 17 through 30, you can see that there's still payments in the policy loan column. And really that's because the balance is still there. And the data that this table it comes from is another table that this is linked to. So it just needs to be there for the math to work out. In this table, we're taking a look at eliminating the debt. So now at the top in the first first 16 months, this is where we're eliminating the debt. And you can see that the policy loan balance continues to increase. In fact, you can see that the policy loan debt by the 17th month is up to $14,288. So we're actually financing more because we're using loans to both make principal and interest payments on the credit card. So not all of our cheap money is going towards the principal. We've got to finance the interest. So that's why it's $14,000 rather than $12,000. But clearly, once you get to the 17th month and all the debt is gone, now we're going to stop making premium payments on the policy. And you can do that because in this case here, I'm assuming a universal life policy. In fact, an index universal life. It's much more difficult with a whole life. I mean, in the traditional double play model, it really doesn't matter whether you use a whole life or an index universal life. Clearly, if you ask me which one is better and which one I use personally, it's going to be the indexed universal life. But truly, any permanent life insurance policy will work for the double play. But here, if you want to be able to stop making premium payments and then resume, that's not something that most whole life policies will allow for. So here you have a lot more flexibility with an index universal life. If you simply stop making payments on the credit on the policy premiums, the policy's charges are simply deducted from the cash value. Now here, we've leveraged this policy to the absolute extent. Now when we stop making the premium payments, we still have those charges coming out. So we're going to take that $1,000 and use it to free up cash value essentially by paying off the policy loan debt, and that frees up cash value that can then be used to cover the fees of the policy. So important thing is the cash value is still growing, but you're also losing it at the same time because you're not adding enough premium to cover the expenses either. But the real thing that you should take note of here is that you've got a lot of money working from day one, and you're going to see when we compare the results what that means. Just the advantage of putting your money to work 1 year earlier and having it have 1 year of compounding in addition to the other scenario. So you can also see in this table the net cash value, and the net cash value is the amount of unsecured cash value in the policy. So I'm not counting the cash value that's already been borrowed against. That's just like extra that we haven't yet borrowed against. That's the leave behind. But once we start making payments on the policy loan debt, you can see that the net cash value around year 17 is increasing dramatically. And it increases up to $28,452.78 by the time we get out to the 31st month, where we've completely eliminated the credit card debt. So while I'm doing an apples-to-apples comparison and I'm showing the same $1,000 a month going towards a life insurance policy versus just simply paying off the debt, I do want you to be aware that, if a year from now you're making more money, you don't have to do this. You could pay as much towards the policy loan interest as you can and still stop paying the premium, or you can pay some of the premium and put the rest towards reducing the debt. Or you could just simply leave the debt there at 4% and handle it in the future whenever you have money. Just pay the interest on it. So you don't have to do it exactly like I'm showing here. But, the more you can throw at it, the better. I'm just using $1,000 per month in each scenario to keep everything apples to apples. But let's continue on and just cut to the chase. On this slide, I'm comparing the outcome of both scenarios. So by the 31st month, I think it's the 30th month in the table on the left. But nonetheless, you can see that one more month would not have made a big difference, because we have a substantial difference. $28,453 approximately of cash value versus $16,127 of savings as a result of waiting a year to begin saving. Again, on the life insurance, all of that cash value was working from the time that first payment was made. The policy loan is something separate. It's like just a loan of the insurance company's money that they're giving to you, but the collateral is the cash value. So as long as you don't default on the loan, it doesn't impact your cash value growth. So that's why it's possible to both pay off the debt and save for retirement at the same time. Or not only saving for retirement, but building up an emergency fund. All right, so to wrap things up, what I wanted to do in this video was just to simply show you conclusively that it makes financial sense for you to take your money, fund a maximum overfunded life insurance policy with whatever you would have used to make a payment on a credit card, and then borrow against the policy to invest in, I'm thinking of double play, to make the payments on the credit card. So basically, we're just swapping out debt. And then I also wanted you to understand that interest saved is every bit as valuable as interest earned. In the double play, we're using cheap money to invest and hoping to earn a higher rate of return, and we're capturing the spread. Here, we're creating a spread, but we're saving the money. And finally, the last bullet point, and one of the most important things to understand, is that the cash value is working the entire time. So that's all I've got on this subject. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, I highly recommend going out to Facebook and joining the Double Play group there. So that's a community of like-minded individuals that are interested in using life insurance for real estate investing. And you can ask questions of those people without having to talk to a high-pressure life insurance agent. Alternatively, I've got a ton of other videos on YouTube, and I've got a ton of content on my website at innovateveretirementstrategies.com. And I consider my website to be a no-fluff zone, meaning it's not like a lot of other websites where there's just a bunch of pretty pictures and fluff, and they make you give up your email address or call in to talk to an agent. Everything that you need to know is available on my website. You shouldn't need to contact me until you're ready to see what the numbers look like for yourself. And if there is something a question that you have that I haven't addressed in the video, by all means, type it into the comment box down below. I get back to comments very quickly. And other people who watch this video and look at the comments are obviously going to get the benefit of the answer to that question. So any questions you have, type them into the comments box down below. And with that, I'll see you in the next video.